Hello, this is Domenico with Easynomics, and we're going to look at a per unit tax um, as in terms of an indirect tax. So for each unit of a good produced, there is an applied indirect tax, a fixed amount of tax for each unit produced by the firm. We're going to assume that we're looking at the market for mobile devices. Price on the y-axis is measured and quantity on the x-axis. So we'll have an upward sloping supply curve, which we'll label S1, equal to the marginal costs of production. And then we will have a downward sloping demand curve that's going to be equal to the marginal benefit. D1 equal to the marginal benefit. So again, this is a indirect tax, kind of like a general sales tax on elastic goods and services. General sales tax, which is typically applied on elastic goods and services. Goods and services with the PED greater than 1, and they all face the same tax amount, okay, which may vary from country to country. So we have the equilibrium set right here at point A that provides the equilibrium price, which we'll label PE, or price at equilibrium, and we have the equilibrium quantity at QE, or quantity equilibrium. So this is the free market level of output at this particular free market price. We can see that the consumer and producer surplus are maximized, so we can just highlight that. We've seen this before. So this triangular area representing the level of consumer surplus, what a consumer is willing to pay for a mobile device versus what they actually pay. And then we can see the producer surplus further down here, which reflects kind of the profit margin of the firm to an extent. The cost of production, the minimum price that they're willing to accept for the mobile phone to cover their costs versus what they sell it for. So the revenue minus the costs gives us producer surplus, which is similar to the idea of profit. Okay, so we want to remember that at point A, at this point, at point A, not only is supply equal to demand, providing the equilibrium price and the equilibrium quantity, where quantity supplied equals quantity demanded, but we should also note that the marginal cost of production is equal to the marginal benefit. Thus, it is allocatively efficient. The free market, in this case, is allocatively efficient. We're providing the number of goods and services that are desired by members of society. This will be altered when the government intervenes by applying a per unit tax. So for each unit, there's a fixed tax attached. So we can represent that by an inward shift of the supply curve, which we'll draw right here. Okay, so kind of an inward shift of the supply curve in parallel. So let's say you have a $1 tax for each unit produced. If you're producing this quantity, you add $1. If you're producing this quantity, add $1. If you're producing this quantity, add $1. So this will be equal to S2, which is S1 plus the value of the tax. Okay? So we see that a new equilibrium is set where S2 equals D1, right? At this point here, which we'll label point B. So we can see that a new higher price is set, which we'll call price paid by the consumer, PC, in this case as price paid by the consumer. But the firm must subtract the tax amount, as that will go to the government, and we'll see that the revenue received by the firm will differ from the price paid by the consumer. So where S2 equals D1, we have that equilibrium price paid by the consumer. And we have a new quantity. We can call this quantity with tax. The quantity with the tax. And we're going to draw another point here to reflect the price received by the producer, which we'll call PP, price received by the producer. So remember, this is the price that's paid by the consumer, but a dollar in this case must be subtracted. That dollar is going to the government, the central government. So the price received by the producer is less than the price paid by the consumer, which makes sense, okay? Because the firm cannot keep the tax revenue. So now we just need to label some areas so we can see the changes to consumer and producer surplus, etc. So we're going to call this A, B, C, D, E, F, G, H, and I. All right, to make it clear, just so we're clear here, I'll continue the supply curve up to that point. I'll continue the supply curve up to that point, and I'll continue the demand curve up to that point. So now we can analyze. I'll analyze first, and then we'll discuss what's the impact on the consumer and producer surplus and other stakeholders. Okay? So as can be seen, we have a graph A, illustrating indirect taxes. We're using a per unit tax. For each unit of a good produced, there's a fixed tax for each of those units. We're going to assume perhaps it's $1 for each unit. And we're looking at the market for mobile phones. On the x-axis, we're measuring quantity. On the y-axis, we're measuring price. We have a downward sloping demand curve according to a law of demand, illustrated as D1 equal to the marginal benefit. And we have an upward sloping supply curve labeled S1 equal to the marginal cost of production. At point A, where S1 equals D1, we have an equilibrium price established at PE, an equilibrium quantity established at QE, where quantity supplied is equal to quantity demanded. And at point A, marginal cost MC1 is equal to the marginal benefit MB1. Thus, this market is allocatively efficient. We're producing the combination of goods and services desired by society. But then the government steps in and they apply a per unit tax. That per unit tax causes the supply curve to shift in, since a tax is an additional cost of production. Thus, this is a non-price determinant impacting the supply curve, causing it to shift inward by the amount of the tax. We can also say it's shifting upward by the amount of the tax. Either way is fine. That establishes a new supply curve at S2 equal to S1 plus the tax. And we see where S2 equals D1. It provides a new equilibrium price at PC, which is the price paid by consumers. So the tax has the effect of increasing the price of the good for the consumer. We have an equilibrium quantity established at quantity tax. And we should note that the price received by the producer is at PP, right? That is equal to price paid by consumer minus the value of the tax becomes the price received by the producer. Okay? So the tax has the effect of increasing the price paid by the consumers, but reducing the price received by the firm, while also reducing the quantity being supplied and demanded into the market. We should note that at quantity tax, at point B, since this is the demand curve, you can note that the marginal benefit at quantity tax is greater than the marginal costs of production. So at quantity tax, the marginal benefit is greater than the marginal cost, which is an under allocation. The tax has led to an impact on the economy where we're producing less mobile phones than what is desired by society. Thus, it generates a welfare loss, which we're going to get back to in the evaluation. Okay, so that would be our analysis, just explaining S1D1, prices, quantities, the shift in the supply curve, the impact on the consumer price, the impact on the price received by the producer, and the impact on quantity. Now we can evaluate. All right, first we're going to look at consumers. Our first stakeholder, looking at how are consumers impacted. They are negatively impacted. All right, they are worse off with the tax. Why is that? Well, because the price has increased for them. It went from PE to price paid by the consumer. And that leaves them with less consumer surplus. So we'll put consumer surplus before, or I'll put before the tax. The consumer surplus was equal to areas A plus B plus C plus D. And then after the tax is applied, the consumer surplus is reduced to only area A. So since consumer surplus before A plus B plus C plus D was greater than area A, that reduced consumer surplus provides less savings to the consumer, so they are worse off. Okay, again, to illustrate that, consumer surplus before is right here. We follow the demand curve up to the equilibrium price, and then when the tax is applied, we follow the demand curve to the new price paid by the consumer, and we see that the consumer surplus has been reduced. So consumer is clearly worse off. Next, let's look at producers. And we can also highlight one more thing I should mention with consumers. We can talk about consumer expenditure. Consumer expenditure, or consumer spending. Before, consumer expenditure was PE times QE, the price paid by the consumer multiplied by the number of units they were consuming. After the tax is applied, they're paying a higher price, PC, times a lower quantity at tax. So again, we can illustrate that change in consumer surplus, which before was this rectangular area, and then it changes to this rectangular area. So consumer expenditure has also been altered. Next, let's look at producers. As we'll see, producers also negatively impacted. Producers as a stakeholder, also worse off. One, because the price received by the firm decreases. It falls from PE to price received by producer at PP, and that will impact their total revenue. So total revenue 1, which is total revenue before the tax was applied, was equal to areas PE times QE, and total revenue after the tax is applied is equal to area PP, price received by the producer, multiplied by a reduced quantity being supplied, Q tax. So we can state that total revenue 1 is greater than total revenue 2 for the firm, so they're generating less revenue, they are worse off. We can also mention the producer surplus. Okay, the producer surplus before producer surplus was equal to areas E, F, H, I, and G. Right? E plus F plus G plus H plus I. And then after producer surplus becomes areas H plus I. All right. We can clearly see that producer surplus before was greater than producer surplus after. So the level of profit being generated by the firm is also decreased. Again, let's illustrate the change in the producer surplus. So originally, it was EFGHI, and then it is reduced to just H plus I. Okay? So total revenue falls, producer surplus falls, quantity of output decreases, which we can see here. Quantity being supplied is decreasing from point A to point, let's say, C as a result of the tax. Remember, the firm is really producing along this supply curve. They reduce their quantity supplied. They stop at quantity tax, they add the tax and sell it to the consumer along their demand curve at point B. Okay? So producers worse off. What about the workers of firms? Third stakeholder, workers of the producers or workers of these firms that produce mobile phones also worse off because the quantity being supplied by the firm is decreasing, right, from quantity at equilibrium to quantity with the tax. Firms are reducing their quantity supplied along their S1 curve, and they're going to fire excess resources like labor, so there'll be increased unemployment. Unemployment, right, in the mobile manufacturing sector will increase. So workers also clearly worse off. Now let's look at the government. I think this is our fourth point, if I remember correctly. The government is better off because now they gain tax revenue. Before the tax was applied, the government earned 0 tax dollars. Okay? But after the tax is applied, the government gains tax revenue, which would be equal to areas B plus C plus E plus F. This rectangular area here, which is also equal to the tax, PC minus PP, price paid by consumer minus price received by the producer, multiplied by the number of units sold, quantity tax. Okay? So the government's better off because they are gaining tax revenue, which we can illustrate in this rectangular area here. BCEF. BCEF equal to PC minus price received by producer multiplied by the quantity of tax is the amount of money being gained by the government. That tax revenue can be used by the government to be reallocated back to society in provision of public goods and services. So this is not a welfare loss because it will be returned to society through government spending. Okay. One last point, let's look at the impact on allocative efficiency. Right, what's the impact on social surplus? Fifth point, social surplus is negatively impacted. We know that consumer surplus has been reduced, producer surplus has been reduced. So let's look at the concept of allocative efficiency. Okay. Before the tax was applied, at quantity equilibrium, marginal cost equaled marginal benefit. But then after the tax is applied, we see that at quantity with tax, the marginal benefit at point B, right here, is greater than the marginal cost of production, which we see at point C right here. So there's an under allocation of resources to the provision and production and consumption of mobile phones. Society would like more mobile phones being produced, but the tax prevents that from happening. And that generates a welfare loss of areas D and G, which we see here, this triangular area. Okay, so the welfare loss is equal to areas D plus G. Okay. All right, so just to quickly highlight these changes, and that will be done. Here is the producer surplus. I'm sorry, the consumer surplus after the tax. Then we have the producer surplus after the tax is applied. And then we have the tax revenue generated going to the government, which is this rectangular area here. So hopefully through this coloring, we can see consumer surplus labeled area A, producer surplus labeled areas H plus I, welfare loss of areas D and G, and the tax revenue generated areas B, C, E, and F. And that's it. So we have analyzed and we have evaluated the impact of a per unit indirect tax in the market for mobile phones. We're also going to keep in mind that it is an elastic good and service, and we'll talk about taxes as applied to the elasticity and the burden of the tax in later videos. And that's it. Thank you so much. Don't forget to subscribe and to like. If you have any comments or questions, you can comment in the comment box below. Thank you.